Welcome to Intraday Trader Training. My name is Toby Gennaro. What I'll be talking about today is intraday trading and the key components and chart structures of this style of trading. Much more intensive trading style as multiple trade opportunities set up on a daily basis. Let's take a look. So let's see how intraday trading differs from swing trading. The definition of day trading is essentially a trade that is held anywhere from a few minutes to a few hours, obviously much shorter than the swing trade. The objective of the day trade is to capture the smaller intraday swings of the market. So we can be using the exact same trade setup with all the same parameters, but we're just finding that trade on a smaller time frame, which means we're anticipating a smaller move, a closer stop, and a closer target that absolutely must be achieved within the current day's trading session. As I've mentioned, these intraday trades are going to be found on significantly lower time frame charts than our swing trade counterpart. So we'll be looking at charts as low as 1 and 2 minutes and possibly using anchor charts like the 5 and the 15-minute time frames to give us a bigger picture view of what's really going on in the markets. Or you can use the 5 and the 15-minute charts as your trigger charts and then using a higher time frame like the 30 or the 60-minute chart as your anchor. So it's up to you on how you want to do it. The higher time frames here will help us to anticipate intraday trend changes and stay on the right side of the order flow. One thing to note when trades set up on a particular chart, make it a point of using that setup chart to provide yourself an idea of the potential lifespan of the trade. This will help you anticipate profit targets and stay in the trade longer. Intraday trading is commonly used on futures markets with high intraday volume, which provides much needed liquidity and price action predictability in the charts we're looking at. You never want to trade intraday on charts with low volume. The price action tends to be spiky and unpredictable. A good way to identify this is by looking for gaps in the price action. Large candles with big shadows and tails. These are the charts you want to avoid for intraday trades. As an example, let's take a look at this 2-minute chart on silver. Now, based on some of the things I've been talking about, I hope none of you would consider trading this chart. Let me just walk you through the reasons why. Some traders may view this as a good ranging chart and then look to trade the price action between the high and low of the range. But there really isn't anything good about this chart at all. There's no trend whatsoever. We have a lot of big candles with large tails. There are gaps in the price action, with some of these little candles even being isolated by themselves. This isn't good. It's indicative of low volume, and you run the risk of your trade being stopped out on a spike in price. So whenever you see charts like this with erratic price action, just move on to the next chart and trade something else. As you begin to familiarize yourself with a variety of markets, you'll start to understand the times to trade various markets and why trading volumes are higher during certain times. A lot of the commodities will have higher volumes during the pit hours, even if you're trading the electronic contracts. The index markets have significantly higher volumes during cash session hours, even though it's a 24-hour market. This is a good example of a chart that you do want to trade. On this chart, we can clearly identify a nice downtrend with successive lower highs and lower lows. The candles are all fairly uniform in terms of their size, which represents consistent selling pressure in the trend. There are no large candles signifying an end to this trend. There is good contract volume here. You can monitor this on a 5-minute chart from day to day on the markets that you trade. Good rule of thumb here on index futures is about 1,000 contracts per bar, more or less depending on the actual index that you trade. It's good to just take a sampling of a nice trending day on the index market that you trade and look at the volumes per bar on a 5-minute chart, and that will give you a pretty good idea of what to anticipate. So if you're an intraday trader and you're not trading index futures, take a look at these. They really are a great contract to trade on the lower time frames. Here are some trading plan considerations that you may wish to think about with regard to the way you trade intraday. Create watch lists from popular futures contracts that you may want to trade. Since intraday trading is more intensive than swing trading, many intraday traders focus on a few select markets and specialize in those markets. The trade setups happen faster on the smaller time frames, so you'll need to think about your setup quickly and make decisions quickly on market moves that you want to be involved in. Your intraday trading watch list should be comprised of all high volume markets with good volatility and no gaps or spikes in the price action. For your trading strategy, Consider implementing a universal strategy that you can use across all markets, whether for intraday trading or swing positions. This keeps your process for identifying trade setups simple, since you're looking for the same chart setups regardless of the time frame. This will get you into the habit of looking for strong trending charts with optimal chart structures and all of the appropriate price action criteria that you're looking for. One of the most important things in your trading is to have a plan. So these are some of the key concepts to get you started. If you're interested in learning more about a trading plan or a trading strategy, take a look at the OpenECRI website for other trading videos and webinars, or you can call customer service for more information and educational events. Thanks for watching OpenECRI's Trading Education.